Hello, I'm David Frazier, President and Chief Market Strategist of Frazier and Mayer Research, LLC, the providers of Investors Monitor and InvestorsMonitor.com. And this is our daily Investors Monitor show, where we strive to tell you everything that you need to know, but nothing more, regarding factors and developments that are likely to affect the value of your investment portfolio. Well, we're recording today's show at around 10:30 in the evening on Wednesday, August 26th. And as all of you probably know, we had a considerable rebound in the U.S. stock market today with the, the Dow Jones Industrial Average closing up over 600 points, 619 points to be exact, or 3.95%. And the S&P 500 index also closing up 3.9%. Now, the impression that I got today from watching approximately maybe 10 to 15 minutes of the major broadcast financial shows, which I tend to watch approximately 10 to 15 minutes every day, not to get any actual important information, but rather just to gauge the perception of the markets. That is, to get an idea of what people are likely thinking due to what most of the so-called experts say on these financial broadcast shows. But I rarely, if ever, really listen to anything that they say regarding factual information. If anything, I might turn on the shows also to use as an alarm clock in a sense to maybe notify me of something that I did not know about, so that I can then go and look into and get the actual facts, because you cannot believe, you can believe if you want, but a lot of what these folks say on these shows just isn't accurate. I'm telling you, it's not. And because of that, as I just said a moment ago, I don't ever really watch any of these shows to get any actual important information. I just watch them to gauge the perception that is being given to financial market participants. And rather than reading financial newspapers or financial magazines or watch these shows, and I haven't read in financial magazines or newspapers for more than 15 years. And the reason being is you can't trust what you read in these publications. Instead, I collect data, a vast amount of data, and that's worked very, very well for me and my firm. By relying on the data rather than what someone says that often has an ulterior motive to make money for themselves, oftentimes, it seems to be the case anyway, by relying on just the data, we've done really well. We correctly called the 2000 to 2002 substantial stock market downturn, the resulting bull market that occurred from 2003 to 2007 we accurately forecast. We also accurately forecast the big downturn during 2008 and the new bull market that began during 2009. And the latest downturn, and I don't know if to say we forecast it correctly, but we advised our clients and investors that listen to us to get in and out of the markets during those periods, because the vast number of statistics that we follow regarding economic and geopolitical developments as well as corporate earnings led us to decide during those periods to get in and out of the markets and to tell our clients to do so. So that's what we did again on March 6th of this year. On May 6th of this year, we once again advised our clients to get completely out of stocks. And that was only approximately 2 weeks before the peak, the most recent peak in the S&P 500. So, I don't claim to be overly smart. We just do our homework. We follow the data. So, what's going on right now? I mean, not right now. Nothing's going on in the U.S. stock market because it's closed. But I mean, what I really mean what happened today in the market, other than the major stock market indices rallying considerably? Well, for one thing, here's what's important to know. If I can get my computer to work here, you can't see what I'm looking at, but I'm having some problems for some reason. That's all right. I don't even need to see it because I know anyway. Yes, the Dow was up more than 600 points today, approximately 3.9%. The S&P 500 was also up 3.9%. But if you look at charts of those indices, stocks in general, as measured by the stock market indices, whether it be the Dow Jones Industrials, the S&P 500, the NASDAQ Composite Index, or the Small Cap Russell 2000 Index, all of those stock market indices simply rally back to right at their high levels for yesterday. They did not go above those levels. So, of course, we had a rally in the stock market, and I'll tell you the reasons why in just a moment. But let's first talk about what most of the so-called experts said on these major mainstream media financial broadcast shows. They said mostly two things. One is that the durable goods report issued today from the U.S. Department of Commerce was supposedly a really good report. And the facts on that, the specifics are, for example, durable goods, that is new orders for durable goods. That is household appliances, automobiles, business equipment, household electronic devices, pricey household goods and business goods that are meant to last for several years, durable goods. Yes, they were up, and that's a good thing versus the prior month. But there was a lot of talk about the orders for those goods being up considerably more than analysts had expected. Well, what analysts are they referring to? What they're referring to when they say that, they're talking about Wall Street sell-side analysts. That is, analysts who get paid to a large extent to support their firm's investment banking clients. And now they'll claim that they don't do that, but if you just look at what they have to say about stocks that their firms have investment banking agreements with, they almost always have buy ratings on any stock that they cover. In general, it's around 93% of any stocks that are ever covered by Wall Street analysts have buy ratings on them. Are you kidding me? 93%? You can't, listening to these guys is a big mistake. And I talked about this a bit yesterday, how, they almost ensure that corporate earnings will beat their estimates quarter after quarter, and they often lower their estimates to such a degree on certain economic variables that oftentimes the readings on those economic indicators come in higher than the quote estimates. So this is not a big deal. Of course, to beat Wall Street estimates. Who cares? What is important is orders for durable goods were up last month, which is a good thing compared to the prior month, but they were down versus the same month a year ago. And in fact, orders for durable goods have fallen on a year-over-year basis during each of the past 6 months. For 6 months in a row, on a year-over-year basis, new orders for durable goods declined. Also, new orders for non-defense capital goods, excluding aircraft. We exclude aircraft because orders for aircraft are very, very volatile from month to month. And that economic indicator and variable serves as a good proxy for business investments in capital equipment, that is such as machinery and equipment to produce their goods. Very, very reliable leading economic indicator. Well, new orders for non-defense capital goods, excluding aircraft, were also up last month, but very modestly. And just as new orders for durable goods, on a year-over-year basis, the orders for those non-defense capital goods declined for the 6th consecutive month, also during July. So, there was not really anything strong about the durable goods orders or the capital goods orders. They beat Wall Street estimates, and, that's supposed to be really, really good. Well, it's not. It means almost nothing. But, a lot of people don't know what I just told you. And when they hear that these types of economic indicators, the readings on those indicators came in higher than Wall Street analysts had expected, it sounds like a good thing. Well, it wasn't such a good thing. It was still good that they were up, don't get me wrong. But, the fact that on a year-over-year basis, down 6 months in a row, for the 6th consecutive month, that is during July, that's definitely not a good thing. Also affecting the financial markets, or the U.S. stock market at least, in a positive way today, was a comment from the president of the Federal Reserve Bank of New York, who said, essentially, I can pull up his quote, I don't think to get his exact quotes really matter. Essentially what he said was that he thinks that the Fed will not need to raise interest rates during September of this year, that they can put off raising interest rates due to the economic slowdown in China and the somewhat questionable direction of the U.S. economy. Well, that got raves by these folks that come on these financial broadcast shows. The president of the Federal Reserve Bank of New York said that the Fed's probably not going to need to raise interest rates now. As if this was new, quote, news. And if you listen to the mainstream media, well, it's something new. Supposedly, everyone expected the Fed to raise rates in September. Well, I did not expect that. My firm did not expect that. We've been telling investors for many, many months that it's very unlikely that the Fed's going to raise short-term borrowing rates, at least in any substantial way, for many more months. And it might be another year or more before the Fed raises interest rates, or at least in any substantial way. And why? It's very, very simple. Because the U.S. economy has continued to grow at a sluggish pace, number one. And number two, there is no problematic inflation rates in the United States. We don't have to be concerned about inflation. So why in the world would the Fed need to raise rates? This is a bunch of nonsense. This comes as absolutely no surprise to me and my firm. So let's get into some other things as to what affected stocks in a positive way today. Well, first of all, margin debt at brokerage firms. That is when, I presume most of you know what I'm talking about when I say margin debt. I'm talking about when account holders at those firms borrow money from their brokerage firms to buy stocks, and at some point need to pay it back. Well, when those folks are invested heavily in a lot of securities, a lot of their portfolios invested in stocks, and they borrowed money to put in those stocks, well, if stock prices come down by a certain degree, those folks will get what are called margin calls, meaning they get a notice that, hey, they got to send in some more money or sell some of their stock holdings, one of the two. And what generally tends to happen most often, I know this is a fact because I worked for stock brokerage firms for several years, is that people in general, clients overall, do not send in more money to cover the margin calls. On average, clients actually instead sell some of their stock holdings. So you've got downward selling pressure, okay? Well, they likely got these margin calls a few days ago when stocks dropped sharply, and then they sold their holdings, and the selling had been done. There was no more selling to be done. There was no more immediate downward pressure on stocks. And if you look at our firm's our firm's overbought, oversold indicator, which is posted on our website under our market timing section. There's a link, a button on our website in the menu bar that reads timing indicators. If you click on that, you'll see to the right short and intermediate term timing indicators, and you'll see the Frazier overbought, oversold indicator. That indicator is based on price momentum statistics, basically, which show the combine the price movements with the volume of trading, and that indicator had fallen yesterday to its lowest possible level. That indicator ranges from 0, it can never go below that, the way it's computed, to 100. So when it's at 100, that generally means that stocks are very overbought on a short-term basis. And everyone that's going to buy is likely already bought. And therefore you won't see stocks go up anymore. You'll see them turn lower for a few days. Or if that indicator falls to 0, that's telling you that stocks are greatly oversold. And in essence, what it means is that everyone that was thinking about selling has already done so. So there's no more selling pressure. So if anyone comes in and buys, well, if there's no, if there's many more buyers than sellers, there's always got to be an equal amount of buying and selling. But if there's more demand for stocks to purchase than it is supply of, then people are willing to sell. If there's a greater interest in buying stocks, that meaning that most people who think about selling are already done so, and you got more people coming in now to buy, well, of course, we're going to get stocks rising somewhat. Secondly, over the past couple of days, all of the major stock market indices in the United States had fallen to major price support levels, which oftentimes when that happens, you'll also see stocks bounce. And all these indicators are on our website. We cover, unlike a lot of firms and so-called experts, we don't just look at the markets just from an economic perspective or from a bottoms-up corporate earnings perspective. That is from a fundamental perspective. Nor do we look at the market and analyze the market purely from a so-called technical perspective. I don't know what's technical about. It's not really any applied science. That's what technical means. Technical analysis, most of you know, has to do with reviewing and analyzing the recent trading action of the financial markets. So we also look at the markets from that perspective. We also look at sector rotation. That is the relative performance of the 10 major economic sectors and where money's rotating. Is it going more into defensive stocks or into cyclical and growth stocks? And so although we did have a fairly substantial rebound today, I'm looking at some notes here to my left, which did not surprise me at all based on what I just told you. People had already covered their margin calls, they'd done their selling, there was no more selling pressure. Number two, these price momentum statistics show that most everyone that's thinking about selling had already done so, and only it's people that are very interested in buying were left. It's not surprising we got a bounce. But when we go back and look at the overall environment, and that is the economic environment, as I said yesterday on the video we produced yesterday, economic statistics and primarily leading economic indicators have been trending lower for several months now. And when these leading economic and leading stock market indicators peak and trend lower, stocks almost always go in the same direction as these leading indicators. So the economy is likely to worsen over the next few months. Are we going to fall into a recession or a deep recession? I don't think so, not based on what we review on a regular basis, but we are seeing a slowdown. Secondly, individuals have been pulling massive amounts of money. It's not really too massive, but they've been pulling money out of mutual funds during each of the past 4 months. Money's coming out of mutual funds. What does that mean? That means mutual funds, I'm talking about stock mutual funds. They're pulling money out of stock mutual funds. And most stock mutual funds, their prospectuses require them to stay fully invested or almost fully invested at all times. So if the shareholders of those stock mutual funds are pulling money out, that means that's going to force the portfolio manager to sell stocks to meet those redemptions from people that are pulling money out, to pay those people in cash. And that's likely going to continue to put some downward pressure on stocks. So, I think I've covered mostly what I wanted to talk about. I know this video is a lot longer than what I expected it to be. Here we go, kind of a long video again today. I'm going to take a quick few notes here. No, I think I've covered everything. I hope you forgive me for the somewhat lengthiness of these videos, but as I said, we strive to tell you everything that we think you need to know, but nothing more about factors and developments that are likely to affect the value of your investment portfolio. So sometimes these videos, this TV show that we produce might be 10 to 15 or even 20 minutes. And sometimes we produce even longer shows, 45 minutes, where we go over a lot of charts to really show you what we're seeing. And other times they might only be 2 or 3 minutes. It just depends on what's important to tell you. So I thank you for listening, and hopefully you'll tune in again tomorrow. Thank you.